Hi, I'm Andrew Kirsh, co-founder of Sklar Kirsh. On this podcast, I interview industry leaders. You'll hear their real-time opinions on today's market, their background, unique career highlights, and guidance for newcomers to the industry. This is the Kirsh Connection. Welcome to another edition of the Kirsh Connection. I get a lot of feedback on the podcast, which I appreciate. And one request was to do a deep dive into a recent real estate transaction. And so this week we have Chris and Charlie Tourtellotte on the show to talk about one of their most recent acquisition, a bellwether portfolio acquisition of 7 properties, close to 1,500 units, approximately a $500 million acquisition of 7 multifamily properties in the Chicagoland area. So we do a deep dive into that transaction, how they sourced it, the equity, the debt, and why they like the Chicago market for multifamily. So I hope you enjoy my episode with Chris and Charlie Tourtellotte. Welcome to another edition of the Kirsh Connection. I'm here with Charlie and Chris Tourtellotte of LaTerra. Guys, welcome to my studio.
Yeah, thanks. Great to be here.
Thanks for having us.
I know, Chris, you and I did a podcast maybe a year, could be even 2
We did.
years
Time is
ago.
elusive. Might have been 2 years ago.
I know.
Yeah.
We did it virtually, and now we get to do it in person with your father.
Much better. And your beautiful new digs. We love it.
Yeah, no, it's fantastic to have Charlie in. And, we were talking before how several of my listeners have suggested or asked, hey, Andrew, you do so many transactions. What about doing a deep dive into one of your bellwether transactions of your clients? And so I thought no better than to discuss the one that you recently closed in Chicago. But before we get into that transaction, no offense to you, Chris, because my listeners already heard about you.
Yep.
We want to hear about Charlie. We want to hear about, your background, Charlie, how you founded LaTerra. So why don't you start from, the beginning? Where did you grow up?
Rhode Island. And when I'm in the LA area over the years, I've learned that a lot of people don't know what that is. So I say it's a state back in New England. So
Yeah.
But I migrated from there fairly early in life, and I went to Colorado from there.
Okay. And then when did you move to LA?
I moved to Southern California in, I guess it was in the late 90s.
Okay.
Yeah.
And then how'd you, were you always in the real estate business, or what was your background?
Yeah, always. It was even before I got out of college. I went to University of Denver, and they have a really good business school there, the Daniels College of Business. And one of my professors lured me into work with him before I even got out of school. And so he and I teamed up and bought 200 plus single-family homes while I was still in college.
Wow, that's
and shortly then thereafter. But he was a real estate tax and securities lawyer, so he taught me the skill of syndication and transactional work, because he was just a master of really that too. So he was a really, I would say, primary mentor of mine in business. And so we did, and we formed a company to own and operate these, and it began to be more than I really wanted in an operational way, because I wasn't really built to be a property manager, but I was running the company that ran the management, but ultimately that wasn't the right fit for me, and I got a good break and moved over to one of what was then one of the big 6 real estate syndication companies of the day. And it was the Robert McNeil Corporation. And I was hired to be in their Western U.S. office to be an acquisition specialist. And so I learned that's where I first learned to buy multifamily apartments, which is a skill set that I can't shake. I mean, it's a thing I can't shake, I should say. And so And then from there, I went over to the Consolidated Capital across the bay over to Emeryville. They were located in San Mateo. And so I went across the bay to Consolidated Capital and worked for them as an acquisition guy, multifamily primarily. And between the two, ended up acquiring over 12,000 units.
And what time period was this?
Oh, gosh. That one now is going to take me back a bit, Andrew. But I think I was between the two about 10 or 11 years, maybe.
Yeah.
A long time.
But you were transacting in, early 80s, mid 80s?
Yeah, oh, yeah. I would say that's exactly right. Early 80s, probably, to start.
Not to date you, but just assuming, making
I'm
an
okay
assumption
to be
here.
dated, believe me.
So when you're transacting in the multifamily business or even in those single family homes and interest rates, what we heard about, obviously Chris and I didn't transact then, in the mid to high teens, and here we're complaining about, a 5-6% interest rate environment. How did people make it work? How were you able to create cash flow with interest rates at that level?
Well, remember I started in the single-family acquisition business, right?
Yeah.
So at that time, that was the run-up. I think it was Jimmy Carter was president at that time, and I don't know if prime went to 20 or 21, or it went way up.
Yeah.
And it created part of the opportunity, which was to buy from owners who were kind of stuck in their homes, but we bought them, I would say, mostly VA and FHA assumable loans. And so that's that. At that time, that was sort of an easier thing to get done, right? Because that was the senior debt on the deal, and so we just put a little bit of equity on top of each one, and that was the syndication part of my experience.
Yeah, Chris, could you imagine transacting in an interest rate environment that your dad was transacting in?
I could not. I can barely imagine it today.
We can't even imagine 6% rates.
Yeah,
let
exactly.
alone,
Yeah.
triple that. And so take us through your career. What did you do next?
From there, and that was a long time, but from there, after it seems like political influences change my destiny sometimes, but the 86 Tax Act came in, and that caused the syndication business to ultimately flame out because there were it was funny, a lot of people don't know that tax benefits went away with that act. And even though it was Ronald Reagan, it was the tax benefits really were significantly diminished. So I would say, after a while, after the 86 Tax Act and not long after, I went off on my own, became entrepreneurial, and did my first deal actually with Jay Kaplan, who was president of Consolidated Capital, and we bought a property in North County, San Diego together. And that was a value add deal. So that was my first value add apartment deal.
And then when did you end up forming LaTerra?
2009.
Okay.
2009. So there was a little bit of gap in between those two things, right? And so we can just skip over a little bit of the golf parts, but when things were really tough after the 86 Tax Act to really continue to get deals done, I went into the golf business with Pete Dye's older son, Perry Dye, who was a good friend of mine from Denver. And I don't want to say I used it already, but lured me in, and he kind of did. Smoking cigars at his pool in Paradise Valley, Scottsdale area. He said, "Charlie, why don't you come over and work with me?"
And so what did you do in the golf business?
And so I did. He said, we got people over here that know how to design golf courses, but nobody knows how to buy any real estate around here. So he said, "But you're going to learn how to play golf," and I didn't know how at that time. So I went over there, and we started a subsidiary called Dye Equity, and Dye Equity. As soon as I got there, there was a set of golf clubs. Perry met me with a set of golf clubs in my new office and said, "You're going to learn how to play golf and get your bags packed. We're going to Japan." So we got in an airplane and went to first Tokyo and then some other places, Osaka and a couple other places. But he had relationships around the East, the Far East, that just loved Dye as a golf course architect, who wanted to invest in U.S. Golf and related. So went over and did a deal with Dunlop Sports of Japan, and then another company, Fuji, not the film, but the bread company there, and those were two very good starts for us. We came back with quite a bit of money in just one trip.
Wow.
Committed capital, I should say.
And so were you buying golf courses or?
Yeah, the game plan was buy and develop and also operate at some point. So we were we did. We had golf courses all over the country, from Orange County at the Los Alamitos racetrack to New Jersey and Chicago. We had one in Algonquin in suburban Chicago, longest par 5 in the state of Illinois, and so I did learn how to play golf. I learned about golf. I learned about design, and I learned about how, where the landing areas are supposed to be, and things that I suppose should make me a better golfer.
And are you?
I'm going to say I don't think I am. I can only say I want to be better.
Well, there's only two types of golfers. Those that have vanity handicaps, and those handicaps are a lot lower than they really shoot.
Right.
Or there are sandbaggers who are much better than their.
Well, we don't know yet which one I am, do we?
I know that not together, but separately, we have played one of the. I don't know. Is it the most secretive or
it's
unpublicized, unbelievable golf course in California called the Institute?
Yeah, it is. It's called the best golf course you'll never play. That's the one review that I read online from a caddy, but it's immaculate and very well done.
Yeah,
owned by the Fry family. We have a venture with them on various Fry's projects, and it's a cool exclusive little club with Steph Curry and other cool members.
Victor Coleman was sitting in your seat, Charlie, a month ago, and he's an avid golfer. I think he said he was a member of Hillcrest and Riviera, maybe Bel Air, and I told him about the Institute. He said I'd never heard of it, and he thought he had known every top end golf course in America. I said, well, you got to play the Institute.
Yep.
So what led to the start and the founding of LaTerra in 2009?
Well, I guess it's fair to say that if I had a golf company, I left Dye because the Japanese had a slower economy occur, and they called me one day and said, Charlie, we're out, and it's super friendly, just great people, and they said, we're out, let's divide everything up and go our separate ways because we can't invest anymore. And so then I started my own golf company, and with Perry Dye's blessing, and he said, take any deal you want with you, just give me the design work if there is any.
Wow.
And so I did just that. And at the time I was working at a downtown Chicago, a site of old rail yards at Lakeshore and Wacker in Chicago, and owner was Metropolitan Structures, and I'll never forget this. Bill Purdy of Met Structures, I called him up and said, I need to come see you. And so I walked in his office because we had been talking while I was at Dye, and he wanted me to do a Dye course there on those rail yards. And so I walked in his office, and he said, I gave him my new business card. He said, it doesn't say Dye on it. And I said, no. He goes, oh, great. Who's in your new company? And I said, you're looking at him. So that kind of shocked him a little bit, and he thought for a minute. We walked over to the window. I don't know if it was 80th floor. It was way up there, right? And I was starting to get vertigo, and I remember this. I was in my early 30s, right? And he said, you mean you want me to lease you that land, that valuable real estate down there for 15 years to do a golf course? I said, yes, I do. And he thought for a minute, and he said, this must have been the golfer in him. He said, okay, if you can deliver Dye and get the money, I'll do it. And I already knew I had Dye.
Yeah.
So I just didn't know yet where the money was coming from. I shook his hand, walked out the door, and called my attorney. I said, start drafting the PPM. We're going to go raise some money. And I walked up and down LaSalle Street for I don't know how long, and I like to say I knocked on 99 doors, and everybody said, "Get out of here, kid! What are you, crazy? We're not doing that." I said, "Okay." So I'm going to keep going because I just believed in it so much. And I went to that 100th meeting, and I'll never forget this. I remember Jack Lasday at Rodman and Renshaw looked at me and he said, "Charlie, I love this deal." I said, "You do?" "You do, yeah." "Great." And so he said, "I can raise the money almost overnight for this," and he did. And
Wow.
I with Dye and Wadsworth Construction, we built a 9-hole best of Dye par threes.
Wait, this is the one in the middle of downtown Chicago,
Yeah,
right?
yeah.
Off Lakeshore?
Yeah, I had to
I
get
can't
it.
believe that.
I had to get it approved, and with the alderman, how the city stuff works.
Yeah.
But I did, and built elevators because it's all multi-story streets there. So
Now, is it still there, or did they
No.
build? I thought they built a hotel on it.
it was right where the Swiss Hotel and the Fairmont is.
Yeah.
But the site itself was zoned for office, and nobody's building office. That's why they needed an interim land use, and that's why it was a 15-year land lease. So,
I see.
But we had takedown parcels, right? So every time a building had to be built, they took down a parcel, and we designed it so that it could go as long as it could as an operational golf facility. We had 100-station driving range, double-ended driving range, with natural bent grass tees and a clubhouse, and I mean it was super successful.
I remember I went to Northwestern undergrad, but that's in Evanston. But I also went to Northwestern Law School.
Oh, you did?
On
Yeah.
Chicago Avenue in Lakeshore Drive.
Oh.
And I always was fascinated by this par 3 golf course in the middle of downtown
We had
Chicago.
17 at Sawgrass, the replica hole.
Yeah.
Just like it.
It just an incredible experience.
Yeah.
And
So it became very popular, and Ernie Banks joined my company and just as a kind of advisor and on the board, and we went public, and so took it public, ran it as a NASDAQ, not just that golf course, but I think we had a dozen or more around the country at that point, and took it public and ran as a NASDAQ traded company for 3 years, and then another company made us an offer that we couldn't refuse. I know it was public, but I did have a large block of the stock, so we sold. And then after having sold, then this transitions me to my next, the next and almost final preceding business before LaTerra. I moved to San Diego, and I just on the street ran into somebody I knew who was in the apartment business, and he said, "Hey, Charlie, I heard you got some money in a balance sheet. Let's go build some houses. I've got a lot. I've got 7 houses, and we're going to go build some houses together." And I said, "We are?" I said, "I don't know anything about building houses. So I know how to buy apartments, but not build any." So he said, so we did, and we got started. And he didn't know as much about building homes as I had hoped. And so ultimately I had to buy him out and take over. And then I continued on and built, I don't know, between me and my team, we probably did almost 1,000 homes.
Wow.
Which became a pretty big home building operation, successful.
what was it called?
Sorry?
What was it called?
It was, the last was Shoreline Communities.
Okay.
And
Okay. So what's more difficult, building golf courses or building homes?
Homes. Golf courses are relatively easy once you start. It's really a big landscaping job.
Right.
For the most part. But so we built a lot of homes, and then the music stopped in, what was that, 06, 07?
Yep.
And had to do a little, sweeping up from all that. But I kept going after in 2009. That's when LaTerra started. I still had a little bit of money left, and a lot of good relationships. And the banks started calling, and they said, "Hey, Charlie, you did great for us. Can you, take over some of the land?" They had a lot of REO, a lot of the banks and lenders, and so we started buying land from lenders and re-entitling, repurposing, and ultimately then reselling back to home builders. And so we didn't build any for long, really any in LaTerra. We just had a big land portfolio. We had, I don't know, $400 million at one point maybe in land all over LA County mostly.
Sure.
Which is what caused me to move to LA from San Diego, because there was just too much business here and not enough in San Diego. So that's how LaTerra started, as a land entitler and designer and reseller. And we made pretty good money at it.
Yeah, I remember those days. During the GFC, I was at Goodwin Procter. We had been representing Lennar. We were representing SunCal. All those guys. I know David Schwartzman was heavily involved during those days, and those were some interesting times.
We became the forward planning department for a lot of the public home builders, because nobody wanted to have land on the balance sheet. So once a month or so, I'd get a call from one of the public saying, "Hey, Charlie, what do you have this month for land that we can buy?" Because we had lots, we were basically paper lot ready to go.
Yeah.
And so it was an interesting time, which really brought me to change the company just organically, because a broker who was selling land said, "Hey, Charlie, would you ever consider doing a multifamily deal instead of single family? I've got this site in Orange County, and the city just won't do townhomes or single family anything. You got to build something that has bulk and mass." And I said, yeah, let's give it a go. So we did, and it was in a kind of a transitional area, very difficult. Chris remembers this because this is right before you joined, I think.
Yep.
And so it was hard to find LP money, just like today. I mean, if it was, no LPs were out there looking for kind of stuff like that.
Yeah, I think that was another example of, 100 no's, basically.
Yeah.
No, to me, I mean, from that golf story to this particular story of at some point, do you just throw in the towel and give up and say there isn't going to be capital for it, or you just keep chugging along and you will not accept that there has to be someone out there that believes in this project just like you guys?
Yeah, I can almost answer that for you because, having joined LaTerra right at that time, it's the latter. I was largely on point for that capital raise alongside my dad, and the feedback was always keep going. You just got to find the right group at the right time, and we did.
Yeah.
Right. And that ended up being one of the most
profitable and successful projects we ever did.
Yeah, built it for around 70, sold it for 100 million. Not long after TCO, ended up being a great project.
No, it's amazing. Yeah. I know the development world has gone through, a metamorphosis, right? Like today, if clients contact me asking, do I have capital relationships that are interested in doing development, and maybe I'm not going to 100 groups, but I'm going to a couple dozen, and it's pretty much no, that they could buy below replacement costs. There just isn't capital for ground up development. I assume you're seeing the same thing, and talk about the transition of LaTerra and how you guys have been a development company and now you're seeing other opportunities.
Yeah, and I'm gonna say, because we're right at the point of our history where Chris joined, right? And first, I want to say I never dreamed I would be this blessed, and I say that because I have the most incredible wife and two amazing sons, one of whom I'm building a generational business with, and he's sitting right here.
That's amazing.
Yeah, that's very nice. It's been super rewarding to work with my dad. It's really quite special. So we're fortunate. And to answer your question, I mean, there really isn't capital for ground up development today. It's starting to come back slowly. There are a couple of groups with some capital, but it's tough, right? I mean, when you can buy brand new apartments for 20-30% below replacement cost, it makes it really tough to justify building. Now, that's not every deal and that's not every location, and new supply is falling off a cliff, and we think that'll create some outsized rent growth in a couple years. And so it's probably a good time to put a shovel in the ground. But that being said, we think it's a phenomenal time as well to buy existing multifamily assets. So we're seeing, the Chicago portfolio is one example, but we're seeing really, I call it generational buying opportunities. I guess it depends, how old you are, if you use that term, right? But it's really, really quite incredible. So we're pretty active in that space, and we will for sure continue to grow and raise capital for that.
Yeah. You want to do our deep dive into Chicago? Let's get into it. So first, why don't you just from a high level talk about the number of properties, the purchase price, the number of units involved?
Yeah, so it's 7 properties, 1,500 units, 1,495 to be exact, and it's really a very special deal. The way we got the deal under contract was through my dad's relationship with Terry Considine, the founder and chairman of Aimco, and ultimately some of the senior folks at Aimco, and my dad's very good friend Tim Hoyer. So we got the deal under contract, and it's very special and unique in that a couple things. One, there was in place assumable agency financing in the low 4% range. So we bought it at really a low 6% cap rate. And you do that math, the maths really well. That ends up with a low double-digit cash on cash, which is really quite unique in today's market.
For sure. It's almost unheard of. Let's talk about how you even got the deal. I know through your personal connections, but what was the largest deal you guys had done prior to the Chicago deal in terms of both asset value, purchase price, and also unit count?
Yeah, I mean, I think our Burbank development, Intro Burbank, that we're building with Quadrille, that's 573 apartments. We closed a $198 million construction loan, and the all-in budget on that is in the mid to high $300 million range plus minus. So that's that's a big project for us, and we've built other large projects in Southern California. But in terms of acquisitions, this is $455 million. That's pretty substantial for us, or for anybody, I guess. But
Yeah.
So that's for sure our biggest deal to date.
Yeah. And so when you got the phone call, or how did it work, and where your friend said, "Hey, would you be interested in this?" What was your reaction? Like, can we take down 1,500 units?
I didn't think of it that way, Andrew. I thought of it more like, where are they and what are they?
Right.
Because I knew, and I always know, for the right deal, there's always capital, always. And it's proven to be true for me. And so he said, look, this was the now president of Aimco and my friend Tim were together in Miami, and they called me, and they said, look, Charlie, we're gonna market. We're going to market with this portfolio in Chicago. And they had been working to sell their Boston portfolio. I think Harbor Capital Group, maybe, or Harbor Group, bought it. And so now we're gonna market and sell Chicago, but not yet. If you want to buy it, we're going to give you first shot at it before we do.
Why? Why would they?
Because my friend Tim convinced them that I was the right guy to get it done, and they could get it done quickly. And they really had planned to sell them one at a time, right? And so there was a long process to get that done. They didn't really look at it as a portfolio disposition for them initially. And so I said, look, okay, let me look at it. And we looked at it, and we underwrote it and spent a lot of time on it internally. And then we said, look, okay, we'll buy these 3, maybe 4. And then the answer came back, no.
It's all 7.
If you really want to do it that way, then we're just going to list and market them and do it that way. And so I thought, no broker, direct to seller, and in a market that is just steaming along now, and a lot of people don't even know that. And so I said, you know what, we'll do all 7.
Let's dive into that right now. The Chicago market. We do, last year we did 180 transactions, and we have a map at the end of the year. We email it as to, where our transactions have taken place. It was over $6.5 billion in 2025. And it's still the same states. There are some groups who will transact on the West Coast, or some groups who won't for a variety of reasons, still the Sun Belt. And now we're seeing the upper Midwest. But I had been transacting in towns like Columbus, Lansing, Indianapolis. Hadn't done Chicago. So did you have to get convinced that Chicago was a great market for multifamily?
We did, but we had good information, right, on these particular assets. And we were actually pretty blown away. So lease trade outs at the properties were 7, 8, 9%, right? So rent increases, annual rent increases. The occupancy rates had been hovering around 98, 99 on some of the properties, 100% leased. No new supply in Chicago, like 0.5% of the existing stock in construction. So no supply.
And I'm sorry, I didn't mean to cut you off, but just so my listeners know, are we talking about downtown Chicago? Are we talking about suburbs? Give us a highlight as to where these are located.
Yeah, well, I would say the answer to the question of the market is really all of the MSA. I mean, even including downtown, but in particular, kind of these first ring locations outside of downtown are where we're seeing, the best fundamentals. So the portfolio that we bought, the 7 properties are in markets like Evanston, where Northwestern is, right? Of course, where you went to school. Lombard, Elmhurst. So these are submarkets with strong incomes, good schools, not far from downtown Chicago, but suburban. So really only one of the 7 is in the city of Chicago. The other 6 are not in the city of Chicago.
And so you get this opportunity, 1,500 units, close to $500 million of real estate. What do you do? What's next?
Next, we got to go find the money, right? You got to go find the money. So we had a great opportunity. We felt like the portfolio price was really good. Like it's kind of like a sum of the parts is greater than the whole, right? Because of the portfolio nature of the buy, with really, in a really good market with really good fundamentals. And I told you about the kind of the cash on cash, right? The math was really good. And we went out to capital, and capital, would say, wow, we cannot find positive leverage, let alone, a low double-digit cash-on-cash deal, really anywhere we're looking. But I would say the capital raise process was challenging, and really that's for a couple of reasons. One, because it was a big deal, right? So people knew that Chicago was a good market. Some LPs said, believe it or not, like we are only focused on Chicago and San Francisco right now because we think that's where the future rent growth is.
How interesting.
Which was nice to hear. But 455, that's a big deal. So not a lot of groups can do that large of a transaction, right? So that was kind of one of the filters.
And I would add to that once we got on an airplane, went and looked at and walked them all. And once we did that and talked to the leasing agents and brokers and really got to understand the market for what it is today, that's when, and saw the quality and maintenance level of these assets, we said, this is a good deal. Because these are long-term. Aimco put money in them for the long term. They were a long-term holder, and they were in good shape. So while we're going to add some more value through improvements because they're not new, right? So, but they're just quality, like Chris said, first ring type locations. And so once we saw that, we said, okay, this makes sense. And the leasing agents telling us about what lease trade outs we're doing and how much, every time, they had, 13 tenants for every 1 vacancy showing up.
Yeah, it's pretty amazing. Remember in the movie The Big Short, when like you got to go to, you got to see what's happening in Florida. Like you won't believe it.
Yep.
And he goes to the strip club and he's like, I don't want to dance. I just want to know, how many homes do you own? She's like, 6. And then he walks out, short everything, right? That's what it felt like. We would tour these properties. Like, we got to see this for ourselves. And the managers are like, we're getting 10% rent growth. Like, there's a wait list. We're 99% leased, 100% leased. And we walk in, buy everything. That's kind of what it felt like.
And our valuation really got better as we were doing diligence through kind of what ended up being a little bit longer escrow period. So that inured to our benefit.
What is driving that rent growth? I mean, you hear at least through media, the migration of people from Chicago and other big cities to the Sun Belt. new jobs, new companies? I mean, what is creating this?
Yeah, I think the bottom line is there is no new supply in Chicago. Virtually nothing has been built. And you can't say that about most markets, right? Including the Sun Belt, of course, where there's, thousands of units being built, right? And you have negative rent growth, negative effective rent growth, and occupancies are dropping. In Chicago, there's no supply, right? So there are wait lists. Additionally, there is job growth in Chicago, in various sectors, including AI. And so Chicago has proven to be a great market. And there's also shifts within Chicago, right? And one of those shifts is a move a little bit out to the suburbs, to those first ring locations. So these properties sit in those first ring locations. So in particular, these properties have benefited from that.
And what is the, so you're assuming debt on all
Yep.
7 properties?
Yep.
And so what is the portfolio levered at?
Yeah, so I mean that, the agency debt came in, around 310 million plus minus, on a purchase price of 455. And I'll say we're very, very fortunate that in our kind of search for a capital partner, we met this fantastic group out of Fort Lauderdale called Respark, and we got along really well with them on a personal level and a professional level, and they're just great. And so we formed a venture with Respark, and together, we went non-refundable and purchased the portfolio. That was really fortuitous that we met them, and it's just been a great partnership.
And to talk about the business plan from a capital market standpoint, from an equity standpoint, I know we've had discussions of what that business plan is like, and then also how much term do you have on the agency debt?
Yeah, so the agency debt on average goes for another 5 years or so.
Oh, that's great.
And some of these loans, like in Evanston, which is an amazing location, right? That property is next to a Whole Foods, next to Northwestern. We're talking like high 2s on that deal, interest only. And so it's, that goes on for quite some time. So call it like an average of 5 years. One thing we're doing on this deal, in case any of your listeners are interested, is we will do a portion of post-close syndication. So we've got the equity. We closed, of course, with Respark, and we're in a great position. But we've made the decision, early before closing, that what the business plan contemplates is we'll buy down a portion of the closing equity with a little bit of a syndication, and that's been going really well. And we'll close that out. There's not, it's not going to be too huge. It'll just be a little piece. So that's ongoing, and that's going well. And our plan is to hold this thing for several years, collect cash flow, sell the assets kind of one at a time at the appropriate time in the market. We think
Super compelling economics
Yeah.
when you think about it, because with 100% bonus depreciation back, so you can get tax benefits and cash flow at the same time, right? So now, if you can get all your cash flow covered by in the first year, 100, you have excess tax benefits, maybe 1.3x on your money.
That's incredible.
Yeah, that's year one, but still, with bonus depreciation, I mean, it's an incredible economic package for investment.
Mm-hmm. And so, what is next for you guys? I mean, you took down this big elephant, and possibly adding to the investor roster for the portfolio. Are you looking to take down, large portfolios like this in the Chicago area, in other locations? I mean, I think we talked about, is this LaTerra 3.0?
3.0
Yeah.
is what we're feeling right now.
Yeah. So the Chicago transaction became the catalyst for LaTerra Capital Management. And LaTerra Capital Management is the vertical within LaTerra, whereby we will take, high net worth capital, we'll take family office capital and institutional capital, and we will invest in existing cash flowing assets. That could include some self-storage, but for sure multifamily. And we've got, on the heels of the Chicago portfolio, we got a couple other things cooking, a couple other portfolio deals and some interesting off-market single asset deals that are well below replacement cost. We'll still selectively do development. We've got some legacy land positions in our portfolio that we think are really attractive, and but the acquisition strategy is something we're keenly focused on. We think it's just such a great time.
Yeah, I know we worked on one together in Marina Del Rey.
We did.
And hopefully that will turn out to be a great development.
That's a premier site.
Premier site. Yeah. So we're you got to kind of move and be nimble with the market a bit, but we are going to be leaning into the LaTerra capital management and existing asset acquisition strategy. We think we got a couple years of runway with this.
Are there markets like a Chicago that you guys are eyeing where perhaps capital may not see the value in that market and that you have to educate them as to look what is happening in this particular market? So another type of Chicago?
Yeah, it feels like every deal we do, there's a level of education of capital.
Yeah.
Maybe because they poke holes or whatever, but Chicago was a really, really good example, maybe the best example. I think San Francisco, everybody wants to be in San Francisco right now.
It's amazing.
I think California, though, Southern California is probably another example of that, right? Where you got to explain to people that LA is very different than Burbank, than Orange County, than San Diego, than Riverside, right? So I think within Southern California, there's a lot of education.
My clients that have portfolios throughout the country of multifamily, both here in Southern California and in the Sun Belt, they've all said over the last 24 months, their properties in Southern California have performed infinitely much better than those in the Sun Belt.
Well, we've got, almost 5,000 units in our company portfolio right now, either in development or leasing, right, or fully leased. And now Chicago is in that number. But I would say that as we think about Southern California, all our properties that we've completed are fully leased and stabilized and getting rent growth, really. And so that's a good barometer for us. And so we see it, almost weekly and monthly in our leasing numbers and velocities. So I think as if we look at other markets, Southern California's, we're here, it's one we know well, right? But we know some others, and we've been working on markets that have a lot of oversupply but still have good growth, right? In terms of population and employment, like Dallas and Phoenix and Atlanta, and markets that where oversupply has forced sellers, to want to and have to get out. And so this is where you can buy, like Chris said earlier, at 30-40% below replacement cost, because they've built new stuff and they've got to sell.
Yeah.
It's probably easier today to get capital for a market that's a high growth market where there's in-migration and population growth, but at the same time there's a lot of supply, like a Dallas, for example, than it is to raise capital for a market with supply constraints, but potentially, questionable in-migration, such as parts of Southern California. But, it depends on the investor, right?
And questionable political changes and legislation that could come down the pipeline at any time. And that is what concerns a lot of capital.
Yeah, some capital says we are only looking at red states, period. Right? I mean, they say it that clearly.
Fortunately, not all.
Not all. No, not all.
But it shifts, right? That's what they say.
Totally.
And by the way, 2 years ago, no one would go into San Francisco.
Yeah, now it's the hottest market.
Now it's the
country.
hottest market. And so 12 to 24 months from now, the shift where capital is going, who knows?
Exactly.
You have time for one more question?
Yeah.
Okay. So, family business. You guys, father, son, and Charlie, your wife also works at LaTerra.
She does.
I have clients that work in similar businesses where there's multiple generations, and I guess just talk about both pros and maybe I don't want to say cons, but just the realities of working father son, husband wife. Talk about how that dynamic is, whether it's internal, external. A lot of my clients are set up in a similar fashion,
They are.
and I'm always fascinated of what the working dynamics are.
I'll just say that Chris came in with a ton of experience. So he's been with us now 11 years or?
Yeah, I came from PGIM.
Yeah.
I know.
In San Francisco, and I think it's important, when the son or daughter goes after college to work and sort of prove yourself. Otherwise, people are always wondering, did the apple fall far from the tree? They don't know. Yeah.
But
maybe it did.
But
we're still trying to figure it out.
Really, because of that long, and good training Chris had, and that was really in development mostly, right?
Yeah.
But
I was at PGIM. I was on the equity side, but
all sides of the
invested in a lot of development.
But because of that, so Chris came in, he was already hitting the ground running. So there wasn't a lot of certain kinds of training needed, right? So today, 11 years later, Chris can do really almost any function in the company that's management level. And so that's a real break for me in that sense. It doesn't mean I do less, it just means that we can do more together. And I think that's really an amazing thing that we can do.
Yeah, it's been awesome. I think it's very special, right? You see these charts, like you read about, it's like your age and your time spent with different people as you get older, right? Your kids go like this, and then it drops off a cliff.
After 12 years old, even.
Yeah. And they say time spent with your parents when you get to a certain age is very low. And sometimes I see those charts. I go, wow, I'm lucky because time spent with my dad, it's still up here, right? So that's pretty cool. Yeah, it's hard to say, negatives. I would say there's probably times when he's like, man, this employee's, talking to me like my son, or it's like, hey, my boss is talking to me like my dad, or whatever, right? But that's just kind of normal stuff.
Or when you guys are at a family function, and do you want to talk about work, or you end up talking about work?
That has happened
guys,
before.
We're at my kid's birthday party.
Exactly. Well, that exact thing happened. And sometimes we'll be at a work dinner with people who may not know. Usually people do, and I'll grab a French fry or something, and you could do that when you're a son.
You take a napkin and you wipe.
No, French fries.
You took us to lunch not long ago, and you saw that very thing happen, I think.
I do remember.
Yeah.
It was great. Look, I really appreciate you guys coming on or into the studio. Charlie, it was amazing to hear about your background. I had no idea that you were responsible for that par 3 course in downtown Chicago. Unbelievable. I wish you nothing but success, both from the Chicago portfolio and LaTerra 3.0. So thanks, guys.
Yeah, thanks for having us.
Thank you for having us.
It was a lot of fun. Sure. And that is another edition of the Kirsh Connection.